Welcome to video 6 of part 1 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here, back with you to discuss retirement accounts and Social Security. While retirement accounts can result in both income and adjustments to income, they are a big enough topic so that they warrant their own video. So here we go. What we will specifically cover are individual retirement arrangements, or IRAs, income from retirement plans, and Social Security income. As usual, we have our free resources from irs.gov. You see publication 17 there and the instructions to Forms 1040. Then also the two big publications for this video are publication 590A and 590B. 590A covers contributions to individual retirement arrangements. 590B covers distributions from individual retirement arrangements. And then you'll see there's a couple of other publications there as well if you want to dive in even deeper. Starting with individual retirement arrangements, you may have heard these referred to as individual retirement accounts, and that is perfectly fine. So arrangements is the generic form, if you will, of the phrase. Then within an IRA, there can be an individual retirement account, which is probably the most common one that you'll hear, or there can be an individual retirement annuity. An annuity is just a series of payments, usually equal payments, that are received over time, over a period of years. They might be received monthly or annually or quarterly, etc., but they are received for several years. That's an annuity. So an individual retirement arrangement can either be an account or an annuity. So any of those phrases is perfectly fine, and we will kind of use them interchangeably as we go about talking in this video. So what is an IRA? It's a personal savings plan, an account, or an annuity that gives you tax advantages for setting aside money for your retirement. So the reason it gives you tax advantages is because the government wants you to save for your retirement, because they know that Social Security is likely not to be enough for many people to fund their retirement. So they want to give you an advantage, tax advantage, to save for retirement. It's an incentive so that you will do that, so that you can help take care of yourself once you retire. There are two basic types of IRAs, traditional IRAs and Roth IRAs. We're going to talk about each of these in some depth. But a traditional IRA, you get a tax deduction now for putting the money in. And then when the money comes out, when you retire, then you pay tax at that time. With a Roth IRA, you do not get a tax deduction now when you put the money in. However, when the money comes out, you also don't have to pay taxes on it. So a traditional IRA, you get your tax benefit now, and a Roth IRA, you get your tax benefit later. That's kind of the easy way to think about them. There are also IRAs for small businesses. There are SEPs. A SEP is a simplified employee pension plan. And then there's a SIMPLE, which is a savings incentive match plan for employees. We will go more into depth on these in part 2 of this series when we talk about business taxation. But just know that those are types of IRAs. And so a lot of the rules, most of the rules you're going to learn today about traditional and Roth IRAs will also apply to SEPs and SIMPLEs. So traditional IRAs, there are two big tax advantages. The first, as we discussed, is you get to deduct the contributions that you make today. That's if you qualify. The second is that the earnings are not taxed until they are distributed, for instance, at retirement. So this is called tax deferred growth. So if you have a savings plan or an investment account, outside of a retirement plan. So if you just take your money and you go to a brokerage and you start buying stocks and bonds or mutual funds, etc., you're going to have earnings each year, hopefully. You may have interest, you may have dividends, you may have capital gains. And if those funds are not in a retirement account, then you have to pay tax each year on those investment earnings. When that money is in a qualified retirement account, you do not have to pay tax on those earnings each year. So the earnings go into the account grows because of the earnings, but you do not pay tax on them. With a traditional IRA, we call that tax deferred growth. It's not tax free because eventually you are going to have to pay taxes on it, but you don't have to pay taxes on it yet. You don't have to pay taxes on it until you take the money out, which presumably would be once you retire. So you put the money in now, you get a deduction for putting the money in. The earnings grow every year until you retire. And even after you retire, as long as the money's in the account, then the account is going to grow with the earnings, and you don't pay taxes on those earnings until they are distributed. So those are the two tax advantages of a traditional IRA. In order to open or contribute to an IRA, you must have compensation. That can be in the form of wages or self-employment income, but you do have to have compensation, and we'll go over the specific rules here in a minute. An IRA can be opened with a bank, a mutual fund company, a life insurance company, a stockbroker, etc. Any authorized financial institution, you can open an IRA there, and there is no age limit for making contributions. There used to be, but there is no longer an age limit for when you can make contributions. For 2023, the most that can be contributed to an IRA is the lesser of $6,500 or total taxable compensation for you and your spouse, reduced by your spouse's contributions to a traditional IRA and any contributions on your spouse's behalf to a Roth IRA. So let's look at this. Most people, because of this, can contribute $6,500 per year. That's assuming they've got enough taxable compensation in order to cover the $6,500. You'll see there that if you are age 50 or older, you can make an additional $1,000. You can contribute a total of $7,500 if you are age 50 or older. You will often hear this referred to as catch-up contributions. Ketchup, not like what you put on a hamburger or a hot dog, but catch up. So this is for people who are age 50 or older, maybe you haven't been saving for your retirement like you would have liked to earlier in your life. And so they allow you to catch up by making an additional $1,000 per year of contributions to your IRAs. You will see a similar concept when we talk about employer retirement plans in other videos. For IRAs, it is $1,000 extra per year if you are age 50 or older. So what this means is that for a married couple, the maximum contribution is $13,000 if both spouses are under age 50. It's $14,000 if one spouse is age 50 and the other is not. And it is $15,000 if both are age 50 or older. And it is not necessary for both spouses to have compensation. So as long as one spouse has enough compensation to meet the maximum, then both spouses can contribute, and then they can get to this maximum amount. Also, it's very important to note these limits, they're annual limits, and they apply to all IRAs you and your spouse own combined, whether traditional or Roth. So if you're a single person, you can contribute a total of $6,500 if you're under age 50 to all of your IRAs. So you can have a traditional IRA and a Roth IRA. You can have more than one of each if you want to, but your total contributions for the year cannot exceed those maximums. Contributions can be made at any time during the calendar year, or, and this is a very nice benefit that they give you, or they can be made by the due date of your tax return for the year. So for 2023, you can actually make contributions, deductible contributions to your IRA for 2023, as long as you make those contributions by April 15th of 2024, which of course is the due date of your 2023 tax return. So this is a way when your clients come into your office after the year is over that you can help them to save money on their taxes. You can recommend that they contribute to a traditional IRA and they get the deduction for that even though the year is already over. And you can actually file the return claiming the deduction even before the contribution is actually made. So, for example, you can file and claim the deduction on March 1st, let's say, of 2024, and make the contribution all the way up to April 15th of 2024, and that's perfectly fine. And then also you can see here, you do not have to contribute every year. So just because you're setting up an IRA, you're not locking yourself into contributing every year. You can just contribute one time and that's all you ever contribute, or you can contribute 1 year and not the next and contribute again the year after that, however you want to do it. Now, there are some limitations on who can make deductible contributions. These limitations depend on a few factors. First of all, depends on whether or not you or your spouse are covered by an employer's retirement plan. Your filing status is something else that helps to determine whether or not and how much you can contribute to an IRA, and your modified adjusted gross income. And when we talk about modified adjusted gross income for IRAs, we're talking about your adjusted gross income, adding back any foreign earned income exclusion. So let's look at these limitations. This is for a traditional IRA. In this chart, we've got two charts. This first one is if you are covered by a retirement plan at work. So the next chart will be if you're not covered by a retirement plan at work. But here we're saying you are covered by a retirement plan at work. So are you allowed to also make deductible contributions to a traditional IRA? So it's going to depend. If you are single or head of household and your modified AGI is $73,000 or less, then yes, you can take the full deduction. If it is $83,000 or more, you cannot take a deduction for making a contribution to a traditional IRA. If your modified AGI is between $73,000 and $83,000, then you get a partial deduction. So the deduction phases out between $73,000 and $83,000. Then you can see for married filing jointly and qualifying surviving spouse, it's $116,000 or less, full deduction, $136,000 or more, no deduction, in between, partial deduction. If you are married filing separately and you make $10,000 or more, then you get no deduction. If you are less than $10,000, you can get a partial deduction, but in no case can you get a full deduction if you are married filing separately. So these are numbers that you probably do want to remember: the 73,000, the 83,000, the 116 and the 136,000, and then the $10,000. You'll want to remember those for the exam. What if you are not covered by a retirement plan at work? Well, then, regardless of your filing status, if neither spouse is covered by a plan at work, and what we mean here is not just that you didn't choose to participate, but you did not even have the opportunity to participate. If you had the opportunity to participate, then you used the first chart that we looked at. even if you chose not to participate. But if you didn't even have the opportunity to participate in a retirement plan at work, then we look at this chart and you can take the full deduction. If you are married filing jointly with a spouse who is covered by a plan at work. So in other words, you've got one spouse is covered, the other spouse is not covered. Then for married filing jointly, it's $218,000 or less. Obviously, if you're single, then you're not going to have a spouse who's covered. So this isn't going to apply. This is only applying for those who are married filing jointly. Then if your modified AGI is $218,000 or less, you can take the full deduction. If it's $228,000 or more, no deduction, and in between, it gets phased out and you have a partial deduction. If you are married filing separately and you have a spouse who is covered by a plan at work, it's the same rules that we saw before. Less than $10,000, partial deduction, $10,000 or more, no deduction. Non-deductible contributions. So those charts were telling you whether or not you can make a deductible contribution. But even if you cannot make a deductible contribution, you can still make a non-deductible contribution. However, the limits, the annual limits for how much you can contribute still apply. So you still can't make more than $6,500 of contributions, or $7,500 if you're 50 or older, but you can make contributions up to that amount even if they are not deductible. Any amounts that are in excess of what is deductible will be considered non-deductible, of course, but they will also give you basis in the retirement account. So what that means is when you take distributions, for example, at retirement, part of each distribution will be taxable and part will not be taxable. It will be considered a return of basis. And so the account holder, the bank or the brokerage house, they'll know how much it was, and they will tell you for each distribution or for your total distributions for the year how much was taxable and how much was not taxable. If you make non-deductible contributions, you would report that on Form 8606 for the year, and that form must be filed even if you're not required to file an income tax return. Now, in the real world, when you're working with clients, if you have clients who are not eligible to make deductible contributions, then what you probably want to recommend is that they make a contribution to a Roth IRA instead. We'll talk about the Roth IRA here in a minute, but Roth contributions aren't deductible anyway, but they have the added advantage that when the money comes out at retirement, even the earnings on the contributions will not be taxed. When you have a non-deductible contribution to a traditional IRA, the non-deductible contributions give you basis, and that basis will not be taxed when the money is distributed. However, any earnings on those non-deductible contributions will be taxed when you take the money out for a traditional IRA. But with a Roth IRA, any earnings on your contributions are not taxable. So if you cannot make deductible contributions to a traditional IRA, you are going to be better off making contributions to a Roth IRA instead. Sticking with traditional IRAs for a moment, there are rollovers. I'm sure you've heard of rollovers. So the typical example that you will have is you'll have money in a employer retirement account, such as a 401k, a 403b, etc., and you will want to transfer that to an IRA, and you can do that, and that is called a rollover. You can also transfer from one IRA to another IRA. For instance, if you are deciding to change banks or change brokerage houses, you might transfer from one to the other. So the easiest way, the cleanest way to do this, and the way you want to recommend to your clients that they do it, is what's called a trustee to trustee transfer. It's totally tax-free and it's very easy. This is when whoever administers, let's say, for example, a 401k plan at work, and you've got a client and they're leaving their job and going to a new job, and they want to get their money out of their old job's 401k plan. So a couple of things. First of all, most of the time, most plans will allow you to keep your money in the 401k plan even if you leave that job. But you're allowed to move it, and a lot of people, once they quit a job, they want to just cut all ties and they want their money out. So they may want to transfer that money to an IRA. So what they do is they fill out some paperwork and they ask their 401k administrator to transfer that money to the bank or the brokerage house or the mutual fund company, wherever they're setting up their IRA. And the 401k administrator transfers that money electronically to that bank or brokerage house, and then the bank or brokerage house goes ahead and sets up an IRA in your name. It's easy to do. It's just a little bit of paperwork, totally tax-free, and it's done, and you don't have to worry about it anymore. The other way to do it is what the IRS technically calls a rollover. In common language, we call all of these rollovers, whether it's trustee to trustee or not, but the IRS kind of distinguishes here, and they say this is what they're calling a rollover. This is when the retirement plan or the other IRA, whoever you're transferring the money from, but we'll say retirement plan, they send you as the employee who's leaving the job, they send you a check in your name. However, when they do that, they must, by law, withhold 20% for federal income taxes. So let's say you've got $100,000 in a 401k plan and you're leaving and you want to roll it over into an IRA. They will send you a check for $80,000, $100,000 minus the 20% withholding for taxes. Now, of course, when you file your tax return for the year, you'll get that 20% back as long as you do a rollover, because the rollover is tax-free. So you'll end up getting the 20% back eventually. But for right now, all you're going to have is a check for $80,000. In order to do the tax-free rollover, however, you must deposit the full amount, the full $100,000 into an IRA. And you have to do that within 60 days of when you received that check in order for it to be tax-free. So you can see the problem here. You have to deposit $100,000, but you only have $80,000. So you're going to have to come up with that $20,000 from somewhere else, or you're going to end up paying tax and penalties on part or all of that distribution that you took from that retirement plan. So let's say you can only do the 80,000, you can roll that portion over, but then you're going to have to pay tax and a penalty if you're under age 59 and a half of 10% for an early distribution from your IRA. So this is the main reason why I said you want to do a trustee to trustee transfer, so you don't get stuck with this dilemma. If this is an IRA to IRA rollover, so you're moving from one bank to another or whatever, then you can only do this once per year. So you must wait a year before doing another rollover, but you don't have to wait a year if it's a trustee to trustee transfer. And of course, as we discussed on a previous video, any transfer of property incident to divorce is tax-free, and that includes for IRAs. Distributions from a traditional IRA. We've been talking about the rules for making contributions to an IRA, but what about when you take distributions? So presumably after you retire. So in general, you will pay tax at your regular income tax rates when you withdraw funds from a traditional IRA. If you have basis in the IRA because you made some non-deductible contributions, for example, then part of the distribution will be taxable and part will not, and it will be in proportion. So you'll take how much basis did you have? So in other words, how many non-deductible contributions did you make compared to the total amount that is in the account? That proportion will not be taxable and the rest will be taxable. In addition to this, if you take any distributions before the age 59 and a half, you are generally going to be subject to a 10% penalty. There are some exceptions to that we'll go into later, but think about it in general. If you take a distribution before age 59 and a half, then you have a 10% penalty. Also, going back up here to your distributions, there are no capital gains rates. So when you have a retirement account, some of the investment income that you got may have very well been from capital gains, from buying and selling stocks, etc. However, when the money comes out, you don't get to pay the lower capital gains rates on that. It's all going to be taxed at your regular income tax rates. So that's the general rule for distributions, is that they are going to be taxable. However, when would they not be taxable? So that's what's on this slide. First of all, if you do a rollover and you follow all the rules, as we already discussed, not taxable. Secondly, is if you make a qualified charitable distribution, a QCD. So this is a distribution directly from your IRA trustee to an eligible charitable organization. If you do it this way, you do not have to pay tax on the distribution. Now, it is limited to $100,000 per person per year. So if you have a very large account, you could do $100,000 this year, $100,000 next year, etc. But it's limited to $100,000 per person per year. And you must be at least age 70 and a half in order to take advantage of this. But if you have a client in this situation, this is a really good deal. If they want to contribute to a charity anyway, then this is a way to get money out of their IRA without having to pay tax. And they can do this whether or not they itemize deductions. So normally what you would do if you didn't have this opportunity and you wanted to give money to a charity, you would take a distribution from your IRA. Of course, you'd have to pay tax on that. Then you could turn around and you could contribute the money to the charitable organization, and you would get an itemized deduction for doing that, as long as you met all of the rules for that itemized deduction. But this allows you to do that without having to itemize deduction, and it allows you to not have to worry about the limits. If you'll remember, there were limits to how much you could contribute in a year depending on your total income, etc. So you don't have to worry about any of that with a qualified charitable distribution. So this is actually a great planning tool for your older clients who have got some money and do want to make these charitable contributions. The next item on the list, tax-free withdrawals of contributions. So this is a narrow thing that can happen, but you can do it. If you make a contribution and you take it out in the same year or by the extended due date of your tax return, then you can just say to the IRS, hey, just kidding. I know I made a contribution earlier, but I figured out I really didn't want to do that. So as long as you take the money out by the due date of your tax return, then you can just ignore it and you do not have to worry about saying that you made a contribution and then that you took a distribution. The only exception is you do have to pay tax on any earnings. So if it was sitting in the account for several months and it did have some earnings, then that's going to be treated just like earnings on any taxable account that you might have, and you will have to pay tax on that. Then the last bullet point here is when distributions are not taxable is the portion attributable to any non-deductible contributions is not taxable, which we already covered. Required distributions. So there does get to be a point when the IRS wants their pound of flesh. They want their tax, because remember, with a traditional IRA, eventually you're going to have to pay tax on it when you take the money out. So the IRS doesn't want you just to keep the money in that account forever, because then they never get their taxes. So what they say is there's going to come a point in time when you reach a certain age that you must make certain minimum distributions from that account. So those are called required minimum distributions, or RMDs. So if you are the account owner as opposed to a beneficiary who inherited an account, which we'll talk about in a minute, but if you are the account owner, you must begin taking RMDs by April 1st of the year following the year you turn 73. So that 73 is a new number. It used to be 70 and a half, and then they kind of eased it in, and each year it went up a little bit. So now we've reached the maximum, at least for now, unless they change the law, and that is 73. So by April 1st of the year following the year you turn 73, so if you turn 73, 2023, then you need to take a required minimum distribution by April 1st of 2024. After that initial RMD that has to be by April 1st of the year following the year you turn 73, after that year, the RMDs must be made by the end of each year, so by December 31st of each year. So if you turn 73 in 2023, then you would take an RMD by April 1st of 2024, and then you would have to take another RMD by December 31st of 2025, and by December 31st each year thereafter. And RMDs cannot be rolled over, because obviously the point of a rollover is to avoid taxes on the money, and the point of an RMD is to make sure you pay some taxes on the money, so you're not allowed to roll those over. However, you can make a qualified charitable distribution and satisfy your RMD that way. So that is a nice way to do it, again, if you've got one of those older clients who wants to make those contributions. If you do not take your full RMD, you may be subject to a penalty of 25% of the amount that should have been distributed but was not. So if you should have distributed $4,000 and you didn't, you could have a penalty of up to 25%. Now that 25% can be reduced to 10% as long as it is corrected within 2 years after the year of the shortfall. So in other words, as long as they go ahead and distribute that excess amount within 2 years, then you can pay a 10% penalty instead of a 25% penalty. So you might be asking, what are these required minimum distributions? How do you calculate it? Well, it is calculated based on the account balance and your life expectancy. So there are IRS life expectancy tables. And so you can see publication 590B if you are interested in that. You do not have to know how to do that for purposes of the exam. And in the real world, the IRA trustee will compute that amount based on these tables and the amount that's in the account, and they will let you know what that RMD is for the year. Distributions, whether they are RMDs or just regular distributions, are reported on Form 1099-R. Federal income tax is withheld unless you choose otherwise. Remember, if it's a rollover, they have to withhold federal income tax. If it is a distribution other than a rollover, then they will withhold income tax unless you tell them not to do so. And you must file a Form 8606 if you receive a distribution that includes any non-deductible contributions that you made through the years, or if you ever rolled over into your traditional IRA any after-tax amounts, then you would also file Form 8606 with your Form 1040. So that's traditional IRAs. Now let's talk about Roth IRAs. With a Roth IRA, you receive no tax deduction for contributing to it. However, there are still significant tax advantages. First of all, the investment grows tax-free, not just tax-deferred. So here, your investment is earning each year interest, dividends, capital gains, and it's growing, and you are not paying each year as you would on an account outside of a retirement account. Just that's the same as a traditional IRA. But the difference here is when the funds are distributed, including the earnings, you do not pay any taxes. They are completely tax-free. So the amounts you contributed, of course, are tax-free because you did not get a deduction for them, but also the earnings are tax-free. So that's the big benefit of a Roth IRA. Because none of it is taxable, there are no required minimum distributions while the account owner is alive. Once they die, that's different. But as long as the account owner is alive, there are no RMDs because the IRS really doesn't care because you're not going to be paying tax on that amount anyway. Just like a traditional IRA, in order to contribute to a Roth IRA, you must have compensation. It can be opened with any bank, mutual fund, etc. There is no age limit, and the contributions can be made anytime during the year or by the due date of the tax return. So that is exactly the same as for a traditional IRA. The limits are similar. The dollar limits are the same as we talked about before because it's your total contributions to any IRAs. But then we'll talk about who can make those contributions, and it's a little bit different. But this slide is the same. So for 2023, the most that can be contributed to all of your IRAs combined is $6,500 if you're under age 50, $7,500 if you're older. And then, of course, if you are married, then you double those amounts. And these rules are going to be the same. So this is the maximum contributions to all of your IRAs. If your modified adjusted gross income is above certain limits, then the amount of your maximum contribution is going to be greatly reduced, maybe even to zero. So this is a little bit different, though. The amount of the reduction depends on your filing status and your modified adjusted gross income only. It does not depend on whether or not you or a spouse participate in a retirement plan at work. So for a Roth IRA, that is not relevant. All we worry about is your filing status and your adjusted gross income. So there's only one chart, and here it is. If you are married filing jointly or a qualifying surviving spouse, and your modified AGI is less than $218,000, then you can make the full contribution. If it is $228,000 or more, you cannot make any contribution. If it is between those amounts, then it is a reduced contribution. Unlike a traditional IRA, where if you don't meet these amounts, you can still make a contribution. It's just not deductible. With an Roth IRA, they're never deductible. So if you do not fit within these AGI limits, you cannot make any contribution to a Roth IRA at all. For married filing separately, you can see it's going to be very much like the regular IRA. So this is married filing separately, and you live with your spouse at any time during the year. Then, if your modified AGI is zero, you can make a contribution. But if it's anything greater than zero, if it's $10,000 or more, you can't make any contribution. If it's between zero and $10,000, then you can make a reduced contribution. So you do have an opportunity here. If it is exactly zero, you have no adjusted gross income, then you can make a contribution to a Roth. But if you have any adjusted gross income at all, then you are either going to not be able to make a contribution or to make only a reduced contribution. That's if you are married separately and you live with your spouse at any time during the year. If you are married separately and did not live with your spouse at any time during the year, then you will fit into this next category along with single people and head of household people. That says if your modified AGI is less than $138,000, then you can make a full contribution. If it's $153,000 or more, you cannot make any contribution. And if it is in between, then it would be phased out and you would make a reduced contribution. So again, these are numbers you are going to want to remember for the exam. Distributions from a Roth IRA. Distributions of amounts contributed are always tax and penalty free. So even if you take it out early and you break the rules, the amounts that you contributed, since you did not get a deduction for putting them in, you will not pay tax or penalty when you take the amounts out. Distributions of earnings that you have are going to be tax and penalty free if the account is at least 5 years old and the recipient is age 59 and a half or older, or they are disabled, or they are the beneficiary of a deceased account owner, or if you're using the funds for buying a first home up to $10,000. So if the distribution meets those criteria, then it is tax and penalty free. So notice here the 5-year requirement. This is different than with a traditional IRA. They don't have anything similar. So what they don't want you to do is, like, you're about to retire, and so go ahead and open a Roth IRA and then take the money out like the next year or just a couple of years later tax free. They're saying, no, the account has to be at least 5 years old and you have to be age 59 and a half or older in order to distribute the earnings tax and penalty free. Again, if you put the money in and you took it out in less than 5 years, your contributions would still come out tax free, but we're only talking about the earnings here. And the earnings, you would have to pay tax if you took it out within those 5 years. And if you are under age 59 and a half, you would have to pay a 10% penalty on those earnings. And of course, in addition to being age 59 and a half, they're also saying you can take the money out if you're disabled or if you're using the money to buy a first home up to $10,000. And then we'll talk about being a beneficiary here in a few minutes. Any other distributions of earnings are going to be subject to tax and the 10% penalty. Other distributions, meaning if you don't meet one of these requirements that we just went over. Recharacterizations. You may be able to treat a contribution made to one type of IRA as having been made to a different type of IRA. Typically, what this will be is you set up a traditional IRA and then you change your mind and you decide you want to make it a Roth IRA. However, it can go the other way. You can set up a Roth IRA and change your mind and change it to a traditional IRA, which might be appropriate in some circumstances. But for the most part, we're going to think about this as you set up a traditional IRA, change your mind, and you'd like to make it a Roth IRA instead. So what the IRS says is, yes, you can do this if you meet some guidelines here. First of all, it must be a trustee to trustee transfer. Secondly, this must be done by the due date, including extensions of the return for the year in which the original contribution was made. So, for example, let's say you set up a traditional IRA in July of 2023. You have until the due date of your tax return in order to do this recharacterization, and that includes extensions. So if you apply for an extension to October 15th, then you can do this recharacterization all the way up to October 15th of 2024. So what you do is you go to the trustee, let's say the bank or the mutual fund company, etc., and you say, hey, I want to do a recharacterization. So what they will then do is they will take and they will transfer all of your money, all that you contributed, and all the earnings on it, they will transfer it to a new account, which will be a Roth account, and that will then be considered a Roth IRA as of the date of the transfer. And you will report that on Form 8606. So let's look at an example. Dean makes a $5,000 contribution to a traditional IRA on August 1st, 2023. In February of 2024, he meets with his tax preparer, who informs him that due to an increase in his salary, Dean does not qualify for an IRA deduction for 2023. On February 15th, 2024, Dean notifies the IRA trustee to transfer the contribution and any earnings into a Roth IRA, which is done the same day, so February 15th. He reports this on Form 8606, and it will be treated as a 2023 Roth contribution made on February 15th, 2024, and the original contribution to the traditional IRA will be ignored. So this is a nice thing that you can do. So when you're talking to a client and you see them that they had a traditional IRA and you talk to them and they decide that a Roth IRA would be better, this is something you can recommend they do, working with the trustee in order to do this recharacterization. And of course, as we mentioned, it could go the other way. Maybe they set up a Roth and you talk to them and they'd rather make a deductible IRA contribution. So in that case, you could go ahead and recharacterize it the other way into a traditional IRA, and then they could take the deduction for making that contribution for the year. Roth IRA conversions. So conversion of a traditional IRA to a Roth IRA. So let's say you have an older traditional IRA. So we talked about the recharacterization, but that's only for one that you just recently set up. But let's say you have an older traditional IRA and you'd like to make it a Roth IRA. Can you do that? Yes, you can do it. It's treated as a rollover, regardless of the conversion method that is used. And the rollover rules apply, except that you don't have that 1 year waiting period that you usually have IRA to IRA. So how do you do this? You can do it a couple of ways. First of all, you can do it by a quote unquote rollover, which means they make a check out to you as the account holder, and then you reinvest that within 60 days. So you can do it that way. Or you can do it trustee to trustee, which of course is what we recommend so that you don't have that issue with the withholding. Or you can do it within the same trustee, can just transfer it. So you may, if you hold your IRA at your bank and you say, well, I have a traditional IRA, you can just have them set up a new account within the same bank for a Roth IRA, and that will be treated as a rollover. Now, when you do this, it is not tax-free, because you're taking money out of a traditional IRA. So you do have to pay tax on the taxable portion of that distribution from that traditional IRA, but you do not have to pay the 10% penalty for early withdrawal. So if you've got a client who says, hey, I think I'd rather have a Roth rather than a traditional, then you just need to explain to them that's fine. You can do a conversion. However, just know you're going to have to pay tax on the distribution from the traditional IRA. But then from then on, you're going to have a Roth IRA. So now it's going to grow tax-free, and any distributions from that point on are not going to be taxable, assuming you meet all of the rules. You can also do a conversion from a simple IRA to a Roth IRA. So remember, a simple IRA is this employer plan that we're going to talk more about in part 2. But for part 1, just know that if you had a simple IRA, you can roll over the money into a Roth IRA. However, there is a restriction, and that is you cannot do it within the first 2 years that you started participating in that simple IRA. So you have to wait at least 2 years. But once those 2 years are over, you can convert the money, you can roll it over from a simple IRA to a Roth IRA, and you can do it the same way we talked about before. You can do a rollover with a check being made out to you and doing it within 60 days. It can be trustee to trustee, or it can be same trustee transfer. And again, you do have to pay tax because the simple IRAs is usually going to be a traditional type of plan. And so you're going to have to pay tax on that distribution, but you do not have to pay the 10% penalty for early withdrawal. You can also do an IRA from an other qualified retirement plan, such as a 401k or 403b or 457 plan, to a Roth, and it is the same rules that we talked about before. Do it the same way that you did the other rollovers, and you're going to pay tax on any taxable portion, but you do not have to pay the 10% penalty on early withdrawal. Now, there are also Roth style 401k, 403b plans these days. So if you were doing a rollover from a Roth style qualified plan, then you would not have to pay tax on the distribution. What we're talking about here on this slide is if you are doing a rollover from a traditional 401k or 403b plan. There's also a Roth to Roth rollover. So you may have an existing Roth IRA and you want to move it to a different trustee or whatever, then you can go ahead and do a rollover from one to the other. And it's the same general rules as for any other IRA to IRA rollover, but you don't have to pay any tax because it's coming out of a Roth IRA. Other IRA rules. So these are rules that are going to apply to both traditional and Roth, unless otherwise mentioned. There are some things that maybe apply to one and not the other, but these are going to be general rules for all IRAs. If you do not follow all of the IRA rules, then you can incur penalties or owe additional taxes. And there are two general categories. There are what are called prohibited transactions, and there are other disallowed activities. So let's talk first about prohibited transaction. A prohibited transaction is any improper use of your IRA by you, your beneficiary, or any disqualified person, for example, your fiduciary or any family members. And these are some examples of prohibited transactions. And you are going to want to know these examples. You cannot borrow money from your IRA. Now, you may be familiar with the concept of borrowing money from an employer plan like a 401k or 403b plan. That is allowed, but you cannot borrow money from an IRA. You cannot sell property to your IRA. You cannot use your IRA as security or collateral for a loan, and you cannot buy property for personal use in your IRA. So you can't, for instance, buy your vacation home within your IRA. That is not allowed. So remember those. You can't borrow money from it. You can't sell property to it. You cannot use it as collateral for a loan, and you cannot buy personal property within your IRA. If the owner or beneficiary engages in a prohibited transaction, it has the following effects. The account stops being an IRA as of the first day of that year, of the year in which the prohibited transaction occurred. So even if the prohibited transaction occurs in December, that account stops being considered an IRA as of January 1st of that same year. So, 11 months earlier. Also, the account is treated as having distributed all of its assets at their fair market values on the first day of the year. In addition to regular income tax, there may be additional taxes or penalties. So that's what happens if the owner or their beneficiary engages in a prohibited transaction. If someone else, other than the owner or the beneficiary, such as the fiduciary, engages in a prohibited transaction, then that person may be liable for certain taxes. And in general, there's going to be a 15% tax on the amount of the prohibited transaction and a 100% additional tax if the transaction is not corrected. So this is usually going to be the fiduciary. So you may have a bank or a mutual fund company, and they inadvertently, usually, will do a prohibited transaction. They don't notice it, or they overlook it, or they just do it accidentally. They're going to have to pay this 15% tax on the amount of the prohibited transaction. And if they don't correct it, they also have to pay a 100% additional tax. What you're going to find in the real world is they're going to correct it as soon as they find out about it. So they can still be liable for this 15% tax, but as long as they correct it, then they don't have to pay the extra 100% additional tax. So those are prohibited transactions. There are other disallowed activities. And again, sometimes tax preparers will just call all of these prohibited transactions. But technically, there is a distinction between prohibited transactions, which is what we talked about before, that you'll want to know for the exam, and then other disallowed activities, which are these. Investing in collectibles. You cannot use your IRA to invest in collectibles. If you do, they will be considered distributed to you in the year purchased. In other words, it will be as if you never actually put them in the IRA at all. They will be considered distributed to you. Also, you cannot have unrelated business income within your IRA. This is something that applies only to trusts that own IRAs. So just know that it's on the list, but you really don't have to worry about it much for the exam in part 1. Part 2, we'll talk more about trust taxes. Making excess contributions. So remember, you've got a maximum you can make, $6,500 a year or $7,500 per year per person. If you make excess contributions, that is not allowed, of course. So if you do not withdraw those funds by the due date, so if you make an excess contribution, you realize you made an excess contribution, then you can just withdraw those funds by the due date, including extensions of your tax return. But if you don't do that, if you don't withdraw those funds, then you must pay a 6% tax on the amount of the excess contribution, and you have to pay that tax each year that those funds remain in the account. So maybe you make the excess contribution 1 year and you don't realize it until a couple of years later. Well, you should still go ahead and withdraw those excess contributions so that you don't have to keep paying this 6% tax, but you will have to pay the 6% tax for the year or years that those excess contributions remained in the account. If it is a Roth IRA, then you can instead, what you can do is you can designate the excess as part of next year's contribution. So if you make an excess contribution to a Roth, then you can say, okay, I know I made too much. Instead of taking the money out, let's just count that toward next year's contribution. Then, of course, that would reduce the amount that you could contribute next year because that would go against your $6,500 or $7,500 maximum contribution for the year. Other disallowed activity is failing to take your required minimum distribution. So we talked about that and the 25% penalty that you may have to pay if you don't take your RMD. And then also, you are not allowed to take early distributions, so before age 59 and a half. And for that, there is that 10% penalty. However, remember, earlier I said there are some exceptions to that 10% penalty. That's what we're going to talk about now. The next 2 slides, are the exceptions to the 10% penalty for distributions before age 59 and a half. Now, it's important to understand these are exceptions only to the 10% penalty. If you owe any income tax on the distributions, then you're still going to pay the income tax. So if it's a traditional IRA and you take the money out before age 59 and a half, you still have to pay regular income tax on that amount. You just don't have to pay the 10% penalty if you meet one of these exceptions. So the first exception is if you take the money out for unreimbursed medical expenses that are more than 7.5% of adjusted gross income. You do not have to pay the 10% penalty on that amount. If you take the money out to pay for certain health insurance premiums after you've received unemployment compensation, don't worry about the details about that. Just know that it's on the list. If the distribution was made because you're totally and permanently disabled, there is no 10% penalty. If the distribution was made because you are terminally ill, as determined by physicians, then you do not have to pay the 10% penalty. If the distributions are made to a beneficiary or estate on account of the IRA owner's death, then there is no 10% penalty on the distributions. If you are receiving the distributions as part of an annuity, there is no 10% penalty. This is one that is often overlooked, so let's spend just a minute talking about it. Let's say you have a person who decides to retire at age 50. Well, if they take their money out before age 59 and a half, generally they're going to have to pay a 10% penalty. But remember, the purpose of an IRA is to save for your retirement. So if you are fortunate enough and have saved enough that you're able to retire early, it really kind of doesn't seem right that you have to pay a 10% penalty because you are taking the money out in retirement. It's just that you were able to retire early. So the way you can get around this 10% penalty is you can start receiving distributions from your IRA as part of an annuity. So let's say you have a pretty large IRA, you can go to your trustee and they can annuitize it for you. In other words, they can say, okay, we will give you monthly distributions for, it can be maybe for the rest of your life, or it can be for a set period of time, let's say for 30 years. Maybe they'll say, we'll give you monthly distributions from your IRA for the next 30 years of $2,000 per month. Well, then even those distributions that you receive before age 59 and a half will not be subject to the 10% penalty for early distributions. But of course, if that's from a traditional IRA, you'll still pay regular income tax, but at least you won't have the 10% penalty. Other exceptions for the 10% penalty: if you're using the amounts to pay for qualified higher education expenses, so these are going to be expenses similar to what we talked about for the education credits, then you do not have to pay the 10% penalty. Up to $10,000 that's used for a qualified first-time home purchase, no 10% penalty. If the distribution is made directly to the government to satisfy an IRS levy on that IRA under Section 6331, there's no 10% penalty. For a qualified reservist distribution, so this is going to be a qualified distribution for members of the military reserves. Again, you don't need to know the details for the exam, just know that it is one of the exceptions. A distribution up to $5,000 for a qualified birth or adoption is not subject to the 10% penalty. And a distribution that is accepted from the additional income tax by federal legislation relating to certain emergencies and disasters. So sometimes there will be a national emergency or disaster, and the IRS will come out and just announce that the 10% penalty for distributions will not apply for the people that are affected by that emergency or disaster. So now let's talk about inherited IRA. So what happens when the account holder dies? So an IRA will generally have a beneficiary named so that when the account holder dies, it will go to that beneficiary. If they did not have a beneficiary named, then there are, of course, estate laws, and each state will have their own laws about how that IRA gets distributed. But for the most part, there's going to be a beneficiary who has been named. So if you inherited the IRA from a spouse who died, you've got three options about what to do. First is you can treat that IRA as your own by just designating yourself as the owner. So then that will just be your IRA and you will follow the rules as if that was your own IRA. Secondly, you can treat it as your own by rolling it into an existing IRA or retirement account that you have. Thirdly, you can treat yourself as a non-spouse beneficiary, and you can do one of the things that we're going to talk about on the next slide. So this is only if you inherited it from a spouse. Basically, you are allowed to treat it as your own by keeping it as its own separate IRA, but designating it yourself as the owner, or by rolling it over into an IRA that you already have or that you set up for this purpose. Or if you don't like those options and you'd rather do one of the things we're going to talk about next, then you can do that instead. So if you are inheriting the IRA from someone other than a spouse, so for example, a parent is a common, goes from parent to child, you are not allowed to treat the IRA as your own. But what you can do is you can take the money and pay any tax now and not have to worry about the 10% penalty for early withdrawals. So even if you are under age 59 and a half, or even if the account holder who died was under age 59 and a half, you can take all the money, pay any tax that's due. So if it's, for instance, a traditional IRA, you're going to have to pay tax on that. You do have to pay that tax, but you do not have to pay the 10% penalty for early withdrawals. Or instead of doing that, you can roll it into another IRA in the name of the deceased person. But if you do that, you must take distributions each year, and you must completely deplete the account within 10 years. But again, you don't have to worry about any early withdrawal penalties. So those are your options. Take the money, pay the tax, or roll it into another IRA in the name of the deceased person, and then you have to take distributions each year and completely deplete the account within 10 years. Now let's talk about required minimum distributions from inherited IRAs. First thing is, required minimum distributions are required for all inherited IRAs, including Roths. So as long as you are alive, if you are the account holder, the original account holder of a Roth IRA, you don't have any RMDs. But once you die, then there are RMD rules that need to be followed even for a Roth. And of course, this also applies to traditional inherited IRAs. For a beneficiary of an inherited account, the RMD depends on a variety of factors. So first, it's going to depend, is the beneficiary a surviving spouse? If they are, then there are certain rules that apply only to surviving spouses. On the other hand, is the beneficiary an eligible designated beneficiary, such as a minor child or a disabled or critically ill child? If they are an eligible designated beneficiary, then they've got certain rules that they follow and certain options that they will have. Next thing that's going to depend is whether the beneficiary is an individual or a trust. So a person can leave an IRA to an individual person, or they can make the beneficiary a trust. And so the options for RMDs can be different depending if it is an individual or a trust who is the beneficiary. Then the other variable is whether or not the IRA owner died before they were required to make minimum distributions. So remember, an IRA owner has to start making required minimum distributions by April 1st of the year after they turn 73. So if they died before that, then your options are different than if they died after that date. So what this results in is that I could spend the next hour easily going over all of the different combinations and permutations. You've got a beneficiary who is a spouse, and the IRA owner died before they were required to take RMDs. You've got a spouse and the IRA owner died after, or you've got an eligible designated beneficiary before or after, or the beneficiary was a trust instead of an individual. You've got lots of different combinations. We are not going to go over all of those because you would spend a tremendous amount of time trying to remember every little subtle difference between these, and there are subtle differences between them. You'd spend a lot of time doing that, and you would not get much benefit because you are not likely to be asked any questions into that amount of detail. And honestly, even if they did end up asking, say, one question on the exam that got into these details, in my opinion, it would not be worth the hours and hours it would take for you to study and to memorize all of those little details. You're better off just guessing on that question and moving on than spending all the time necessary in order for you to get that question right. And as I said, they're not likely to ask you those questions anyway. So what I'm going to do is give you enough information that you can answer the types of questions that are likely to be asked. So that's what I'm doing here on these slides. So first, you're going to remember that it is going to apply or apply even to Roth if it is an inherited account. Secondly, you're going to remember that the amount and the amount of the RMD is going to depend, and the options for how the RMD can be made is going to depend on a variety of factors that we have listed here and already gone over. And then the last bullet point here is, what if you are not a spouse or an eligible designated beneficiary? What are your options? So in most cases, for individuals who are not eligible designated beneficiaries or spouses, there's something called the 10-year rule, and that is very similar to what we already talked about, the 10 years. And that is that it must be completely depleted within 10 years. There's no early withdrawal penalty. And if the account holder had reached the RMD age, then the beneficiary must be taking distributions each year. But even if they're not taking distributions, that account must be completely depleted within 10 years. So if you are not a spouse or an eligible beneficiary, remember the 10-year rule applies. Now what I'm going to do is give you a sampling of some of the options that spouses and eligible beneficiaries have. So again, this is typical options. The exact options they have are going to depend on all of those factors we talked about before. I'm just trying to give you an overall idea of the kinds of options that spouses and eligible beneficiaries have depending on the particular circumstances. Frequently, they will have the option to roll over the account into their own IRA and to follow the regular RMD rules based on their own age. Or they can keep the account and delay distributions until the account holder would have been 73. They then take distributions based on their own life expectancy. So they look to the age of the account holder for determining when the required minimum distributions start, but they look at the age of the beneficiary to determine the life expectancy to compute the amount of the required minimum distributions. Or another option that they frequently have is to go ahead and follow the 10-year rule that we already discussed. And then another option that they will always have is to take a lump sum and pay tax on any taxable amount. So again, the exact subtleties and nuances are going to be a little different depending on if it's a spouse, depending on if it's an eligible beneficiary, depending on if it's before or after the original account holder was required to take RMDs. But gives you a sampling, a flavor of the types of options that people will have for their RMDs in those circumstances. In any case, if the account holder was required to take RMDs and did not do so in the year of death, so let's say they were 75 years old, they were supposed to take an RMD that year, but they died before they took the RMD, then regardless of which option gets chosen, the beneficiary must take an RMD on the account holder's behalf for that particular year. So the year you die, you still have to take an RMD. It's just that if you didn't take it before you died, your beneficiaries are going to have to take it on your behalf. So that is it for IRAs. We're now going to move on to income from retirement plans. So we've talked a little bit about this when you get distributions from IRAs, but of course you can have income from other retirement plans at work or from other places you may have retirement plan, the military, etc. So let's talk about those. First of all, distributions from retirement accounts are reported to the recipient on a Form 1099-R. The 1099-R should report how much of the distribution is taxable, because remember, you could have a mix of taxable and non-taxable amounts, but sometimes it will not do that. Just remember, if you never made any post-tax contributions to the plans, then it's usually all going to be taxable. So if you had a traditional IRA, you never made any non-deductible contributions, or you had a traditional 401k plan at work, you never made any non-deductible contributions, then the whole amount is going to be taxable. If you're not sure, or you did make some non-deductible contributions and it was not reported to you on 1099-R, you can compute the taxable component yourself. There's what's called a simplified method that people usually use, and that is in the Form 1040 instructions. So you can go to the 1040 instructions and check out that simplified method. But again, for the exam, you are not going to have to worry about that. You're not going to have to compute the amount that is taxable and the amount that is not taxable. So for the purposes of the exam, just know that any amount that is taxable, you have to report and pay tax on. Any amount that is not taxable, of course, you do not have to, you still report it, but you do not have to pay taxes on it. If you had a pension that started paying before July 1st, 1986, there's something called the general rule that you can use. There's not a lot of those pensions around anymore. And again, don't worry about the details of that. If you did not want to go through the hassle of computing the amount as taxable, the IRS will do that for you. However, they will charge you a $1,000 fee. So just know that that exists. Most of the rules for distributions from IRAs also apply to distributions from employer retirement plans. So you've got the 10% penalty for early withdrawals. Those same rules are going to apply to 401k, 403b plans, etc., including the exceptions. Those also apply. Amounts can be transferred from a employer plan to another retirement account or rolled over into an IRA. You can actually transfer
if the plans allow for it, you can transfer from one employer's plan to, for instance, a new employer's plan. You can transfer amounts into your new employer's 401k plan, or as we discussed earlier, you can do a rollover into an IRA. And there are required minimum distributions from employer plans. And it's just like from an IRA, they must start by April 1st of the year after you turn 73, except for the Roth type plans. Of course, you do not have those RMDs. So you're going to have a lot of those same rules that you see with IRAs. You can just kind of assume that those apply to employer plans as well. One difference that we mentioned earlier is that if the plan allows for it, you can borrow from an employer plan. And as long as you pay back the money on schedule, they will give you a schedule of when you have to pay the money back. And as long as you follow that and you pay the money back on schedule, which you'll usually do via deductions from your paycheck, so it makes it easy to do and so that you don't forget about it. As long as you follow that schedule, then that distribution is not taxed and there's no penalty or anything like that. Moving on to our last topic for this video, Social Security income. Social Security income is reported on a form SSA 1099. So usually a 1099 is a 1099 dash something, 1099 dash DIV or dash INT or dash R for retirement plans. But for Social Security, it is an SSA dash 1099, and you'll see several boxes on the form, but box 5 is the amount that you will need to report on the tax return as Social Security income. That Social Security income may or may not be taxed, or part of it may be taxed. So the income might be completely tax-free, or it might be partially taxable, and that depends on the amount of your other income, which we'll talk about here in a minute. But in any case, no matter how much other income you have, no more than 85% of your Social Security income is taxable. You do want to remember that number. So how much of your Social Security income will be taxable? It will be anywhere from 0% to 85%, but it will not be more than 85% that is taxable. So to determine if any of your Social Security benefits are taxable, you add up 1/2 of your Social Security income plus all of your other income, including your tax-exempt interest. And we will go through an example. But just remember this. You take half of your Social Security income and you add to it all of your other income, including your tax-exempt interest. Then you compare that to your base amount. If you're single, head of household, or qualifying surviving spouse, the base amount is $25,000. Similarly, if you are married filing separately and you lived apart from your spouse for the entire year, then it's $25,000. If you are married filing jointly, the base amount is $32,000. And if you are married filing separately and live together or live together for any part of the year, then it is $0. So half your Social Security income plus all of your other income, compare it to your base amount, and that will tell you how much of your Social Security is taxable, up, of course, to the maximum amount of 85%. If your computed income is less than your base amount, then none of your Social Security benefits are taxable. If it is more than your base amount, part of the benefits are taxable, and there are worksheets in the 1040 instructions to use to determine exactly how much is taxable. Let's do an example. Flo and Joseph are married and file a joint return. Flo received $18,000 in Social Security and Joseph received $14,000. Flo also received a pension of $1,000 per month and had tax-exempt interest of $3,000. Half their Social Security is $16,000. So together they got $18,000 plus $14,000. That's $32,000. So half of that is $16,000. The pension is $1,000 per month, which is $12,000 per year, and the tax-exempt interest is $3,000. So you add all of that up. Their total income for doing this calculation was $31,000. They have no other income, so their base amount is $32,000 because they're married filing jointly. Therefore, none of their Social Security benefits are taxable. So that is how that works. And that is it for video 6. I will see you on our last video for part 1, video 7.